Hello and welcome to my channel. In this video, we would be covering chapter number 7, Concept of Financial Planning. This video is part of NISM Investment Advisor playlist. I've already uploaded many other videos in this particular module, this particular playlist. So I request you to please go through all those videos. You can find the link to the playlist in the description box of this video, at the I button as well as at the end of this video. If you like it, do hit the like button and do not forget to subscribe to the channel for more financial and banking videos. Now let's start with this one. Financial planning is the process of assessing the income, expenses, assets and liabilities to develop a comprehensive plan to meet current and future financial goals. So it becomes very important to plan your finances so that you don't run out of money, and whenever you require, you must be having sufficient amount of money to fulfill your financial goals. We would be covering what all could be financial goals, but for now, understand that analyzing your current financial situation becomes an important part of financial planning. What all income sources you are having, where are your expenses going, what all asset you are having, so the properties you are owning, what are your liabilities, any loan if you have taken, what is the amount of that liability. It becomes all important to do analysis so that you can make a proper financial planning, how much more amount you would be requiring in the future course of time for fulfilling any financial goal, where you should invest the surplus amount, your savings, where you should invest that, in what all schemes or what asset classes. So financial planning deals with all these things. It works primarily through identification of major goals and putting in place an action plan to ensure adequate finances to meet those goals. So as I said, when we talk about financial planning, whenever we plan to achieve certain goal. We are making a plan because we want to achieve something. So same way, if we are planning our finances, we must be having something in our mind to achieve. So those are called financial goals. Those goals could be different. It's a holistic approach that considers current financial situation, evaluates the future needs and risk involved, and develop a framework to fund those needs and review the progress. So it just not only analyzes your current financial situation, but evaluates what all future needs could occur. So this is why planning comes into picture, because you are planning for future course of time. There is risk involved, there is inflation involved, there is different financial goal that could come, the emergency fund, the emergency cases could happen. So for all those things, you need to be prepared with your finances so that it does not get a burden on you and you don't live a life miserably. So it becomes important to do a proper financial planning, and not just developing a plan, then you need to review your progress. Every time you need to review your progress with that plan, whether you are able to achieve what you thought of or not. So let's move on to financial planning process. So starting with the identification of financial goals. Then you need to assess your current financial situation. You need to do risk profiling, asset allocation or investment, and then constant monitoring and rebalancing is required. So one by one, we would be talking about all these 5 components of financial planning process. Identifying financial goals. Now, financial goal describes the future needs of an individual that require funding. Identifying financial goals help put in place spending, saving, and investing plan so that current and future needs are met as and when required. So financial goals are the things that you want to achieve in future course of time, and that would require certain amount of money to be spent. And along with time, you know that the inflation rate is there. So the purchasing power which you are having right now of your money won't be same. So the value of 100 rupees which you are spending today, after 10 years, 15 years won't be same. So the value of commodities, everything would increase. So you would be end up spending more. So we need to consider that inflation factor also when we are setting our financial goal. So how much amount will be required at future value of that, at future value, because we are considering the goals that need to be fulfilled in future. Now, these financial goals involving large sum of money may be like buying a home, children's education, children's marriage, medical expenses, vacation plans, and retirement goals. So these are few examples. For example, you wanted to buy a home, you wanted to get a car, you wanted to plan for your children's higher education, children's marriage, any medical expenses, as medical expenses are rapidly increasing, so you need to manage a large amount of money for that. Any vacation plans in mind which cost you a huge amount, retirement goals. All these are some of the examples that you could set as your financial goal. It depends on the individual, so you may be having your own goals to achieve. Now, future value of goal. As I said, you just don't need to set a financial goal. You need to estimate what amount would be spent in that goal achieving. So, what would be that amount? Now, future value of goal would consider below mentioned three factors. First is current value of goal or expense. So, you need to think that. So, let's take example that you wanted to save for your child's higher education. Now, current value of that post graduation course is rupees 8 lakh. So, what would be that 8 lakh rupees when your child would be joining? So, time to join college, let's assume would be 10 years later. So, after 10 years, your daughter or your son would be joining that college, and the current post graduation cost of that particular institution is rupees 8 lakhs. So will it remain same after 10 years also? Of course not. So we need to consider the inflation rate. So let's assume an inflation rate of 7%. It's always good to be a little conservative and assume a higher inflation rate than actually going, because that would be help you investing for a larger sum of money, and you don't lack on cashes or amount when required. So it's always advised to be a little conservative when assuming something, when assuming inflation rate and cost, etc. So let's assume the inflation rate 7%, time to join college is 10 years, and the current cost is 8 lakh. So we need to assess the future value. What would be the future value? So 8 lakh into the inflation rate percent, 1 plus 0.07 raised to the power number of years, that is 10. We would be getting it as 15 lakh 73,721. So it's almost double the amount. You can see the difference. What with the same money power which is at the current time rupees 8 lakh would be doubling in the time of 10 years. So this is how you need to consider the inflation factor. Now, if you want to accumulate this 15 lakh, you must save and invest so amount at certain rate of percent which you could get that, so that you could accumulate this amount of money at that period of time. So for example, for 10 years you could invest in any equity oriented mutual fund which would be giving you a rate of percent around 10%, which would be giving you a rate of return of about 10%. So with that value, maybe you can calculate the future value and you can get an idea that will it be equal to 15 lakh 73,000 and so much, so the corpus required. So thus you need to estimate how much you should invest in any particular scheme, what return you would be getting, and will that future value of return would be equal to the future value of the goal which you want to pursue. So this is how you could go about your financial goal. Let's move on, and we are coming to the next step in process, which is assessing our current financial situation. So we need to categorize our finances in four broad categories, that is income, expenses, assets, and liabilities. So income is generally what is generating you cash inflows. So you are earning through your job, you are earning through your business, or maybe you are earning through any rent. So that all is considered as an income, because that is regularly generating you some sort of cash flows. Now, expenses is what you are spending. So here you could keep a control on your expenses and not get on to the lifestyle inflation factor, and you try to manage the difference between needs and wants of your, and thus you would be able to save the surplus amount. So out of income, how much after expenses you could save as surplus, because that surplus would serve as your investable surplus, which you could invest to generate money over a period of time. Now you also need to find out the difference between asset building and liabilities creation. So many people tend to take loans like car loans, etc. So these unsecured loans, the personal loan, the credit cards, the car loans, these are unsecured loans. These are personal loan and credit card are unsecured loan, and car loan, if you are taking, that is the loan for the asset which would be depreciating over time. Yeah, the value of car would be depreciating. So you are not taking loan for wealth creation. Other than that, you are taking loan, and you are disturbing your finances for future period of time. So it's better advice not to take loan until you need. It's better to spend some time, save, invest, accumulate that wealth, and then fulfill your want rather than taking loan to fulfill your want. And even if taking loan for certain asset building is necessary, like you want to buy a home and you want to take a loan for that, it's okay, but you need to generate income from that house also. So put your home at rent and you would be generating regular income out of that. So try to convert your liabilities into assets, and this is how your assets are the properties which you are owning. So it may be in form of land, it may be in form of a house you are owning, it may be in form of all the stocks which you are owning, the investment you have made, the gold, etc. So all what is the overall amount of assets which you are owning, and what is the liabilities that you have to pay off. So after deducting the liabilities from asset, what you would be left would be your net worth. So that would actually be the value of property which you have created over this period of time. So as I said, assets minus liabilities would give you net worth, and this net worth would be telling your actual financial position. Income minus expenses would be providing you the saving or surplus figure, and these saving and surplus, you just know, don't need to keep it stagnant. You need to invest. You need to invest in mutual fund schemes, or maybe in stock, bonds, any asset classes as per your risk taking capacity and the return percent which you expect. Now, it's also suggested that you prepare a budget periodically. So preparing a budget would give you an idea where you are spending much, where you are, where, what all are your income sources. So where do you need to cut on? So regular budget preparation would give you an idea what you planned and how much you were able to execute according to that budget plan. Were you falling in that budget or not? So preparing a budget also limits you to spend in the estimated amount. So if you have estimated that I need to spend only 1,000 rupees for this purpose, so you would be ending up and trying to manage to spend within that limit. And if you have not estimated, it somewhere won't be in your mind and you would be ending up paying more. So it's better to prepare a budget periodically. Keep a track of all cash flows. Cash flows, what cash outflows are your expenses, and cash inflows are the income sources which you have created. So keep a track whether your inflows are more than outflows. It should be more than your outflows. Then only you will be able to save on surpluses and invest. Work towards creating assets and generating more income sources, and also work towards paying off your debts, liabilities, and cutting down on unnecessary expenses. Because by doing these two things, you would be able to manage your finance. That would be the basic step, the basic approach to move towards being financially independent. Coming to risk profiling. So as I said, after we have assessed our current financial situation, what all things we are having, we need to have a look at our risk profile. So risk profile is made up of two components: risk appetite and risk tolerance. Now this risk profiling helps you in choosing the asset class in which you would like to invest. I would tell you how it happens. So risk appetite is the amount of risk one is willing to take. So what risk you are willing to take? Are you willing to deal with the stock market fluctuations? Then if you want to be affected by it, many a times the shares which you are owning would go down by a larger return percent, and that if that does not affects you, that does not fear you, because that stock market is volatile and you are having full confidence in the share in which you have invested, and you are ready to be invested in it for a longer period of time. If all that factors does not fear you, your risk appetite, your risk willing capacity would be on higher side as compared to the persons who only invest in fixed deposits, or who like to keep their money in saving account, or they like to invest in very secure provident funds, pension schemes, like all these things, or maybe or maybe investing in gold. So safer side instruments which would be giving a fixed return, but it would be lower, but there would be some certainty and very less risk involved. So that would be an individual capacity, how much risk you are willing to take. Risk tolerance is the amount of risk one's finances allows to handle. So the appetite was how much you are willing to take, and tolerance is how much your budget allows you to take. So you can't, if you are having a surplus of 10,000, you can't just put all the money in stocks taking the higher risk side. So 100% you have invested in equity oriented schemes, and maybe if you would be losing, you would be losing all your amount. So risk tolerance is what your budget allows. So budget would recommend you that you should allocate this much amount in conservative schemes and this much in aggressive schemes as per your risk tolerance ability. A risk profile is an evaluation of an individual's willingness and ability to take risk. And thus, by looking at your risk appetite, risk tolerance, a risk profile is created. So this risk profile would give an idea about which all instruments you are ready to invest in. Risk profiling is important to determine a proper investment portfolio. So, as I said, after all, you have collected the surplus amount, you need to invest that. And to invest in a particular portfolio, you need to analyze your risk taking capacity. Now, factors affecting risk profile. So, number of dependent. Yeah, so your risk taking capacity also depends on how much dependent members you are having. So if you are a single earning member and all your children, your wife is dependent on you, you may be on a safer side and you would be taking a little risk because you are having their responsibilities. So you can't end up taking higher risk if you and the fear of losing all the amounts. So it would affect your family. So it also, risk profile also depends on the number of dependent members. In the same way, if let's think of another condition in which you and your wife both are earning, so your risk taking ability would be a little on higher side, because even if one's money is a little disturbed, the other member's money is there to handle the family needs and wants. Thus, number of dependents affect your risk-taking capability, number of earning members as well, as I said, asset and liabilities, how much loan you are having, how much debt you need to pay. So if you are having a lot of amount of debt on you, the first recommendation is to pay off your debt, because after being debt free, it would be advisable to invest in riskier side. Before that, you don't need to invest. You first need to cut off your liabilities. That should be the first priority. The income and expenses also decide how much surplus you are ready to invest and how much risk you would be able to take. So if your income is higher, you would be on a higher side of taking risk and investing in equity oriented funds to generate higher returns. The financial goals. So what all goals you wanted to achieve and in what time period. So if you are having a smaller time period, like in 3 years of time, I want to buy my own home, that would require a large corpus. So the 3 years time period is quite less and the corpus required is quite high. So you need to invest in those funds, in those asset classes where you would be able to generate higher returns. Other than that, if you want to if you are investing in real estate, so that won't be a liquid fund. So if you know that investing in land, investing in real estate would block your money for a certain period of time. It won't be very convenient to sell off and get the money. So if you are investing and you want that there should be a liquidity maintained, as and when you require, you get out the money. So for that reason, you should not invest in real estate. It should be, investment in real estate should be for appreciation over a period of time, because the land value would be growing exponentially. So that should be for capital appreciation, wealth creation over a longer period of time. Then your risk and returns, risk taking capacity and return expected. These all are the factors that affect your risk profiling. So on the basis of risk profiling done, the individuals could be categorized as secure, conservative, moderate, growth, and aggressive. So secured individuals are the individuals who wanted to be on a very safer side and they don't want any risk in their investment amount. So they would be investing 100% of their 100% of their investable surplus in debt category and zero in equity. So they would be expecting a return of about 6% over the time. Conservative are the individuals who are ready to take little risk but not much. So they would be investing 80% in debt and 20% in equity, which would be giving about an expected return of 8%. The moderate individuals are who are ready to take a balanced risk. So they would be investing 50% in equity and 50% in debt and would be expecting a return of 10%. Growth are the individuals who are ready to take higher side of risk. So they would be investing 80% in equity and 20% in debt, and thus they would be expecting a return of 12%. Aggressive are the individuals who are totally risk oriented, who always wanted to play in the share market, who wanted to be on the higher side of risk to gain higher maximum profit. So they would be ready to take losses as well in the same condition. So they would be allocating 100% in equity and 0% in debt. Thus, they would be expecting a return of more than 15% if they are taking such a higher risk. Coming to asset classes, so we have decided what could be the, according to risk profile, what kind of individual you could be and how much percent you should allocate in what instrument. So what all could be asset classes? Equity, debt, metals like gold, silver, you can invest in that as well. Real estate, you can invest in land and the appreciation would give you a good rate of return. The commodity market, you could invest private equity or art. So private equity, generally you are investing in any business, any startup. So for those people who have accumulated a large amount of wealth, they could invest in startups, and if the startups would grow, they would be earning returns out of it. Investing in art, this is not much popular in our country, but yeah, it's also an asset class and many people invest in it. So asset allocation. According to your investment objective, what could be suitable investment? So if your investment objective is of growing your fund, capital appreciation, you should mostly invest in equity shares, equity mutual funds, real estate, small cap funds. So these all are, other than real estate, equity and small cap funds are riskier avenues, and thus you would be generating higher rate of return over a period of time. It's if you're not sure about share market, you must not invest before getting the knowledge of it, before analyzing the stocks completely. So in that case, you may invest through equity mutual funds, and you can choose small cap funds because these are mostly the growing company which can grow exponentially over the period of time. So these are riskier, but in spite taking risk, you may end up getting higher returns. And real estate also comes in growth and appreciation investment objective. If your investment objective is to protect your capital and get a source of regular income at a certain fixed rate of percent, so you must invest in debt funds, fixed deposit, balanced fund, diversified equity, bonds, government securities, gold. So these are safer investments which would provide you about 7 to 8% of return, and that would be fixed. Your capital would be protected. So you are not taking much risk and you are generating a regular income source for you. You could invest for liquidity, so short-term funds, money market instruments, current and saving account deposit, or you may keep as cash. So if your aim is to build an emergency fund because anytime any medical emergency comes in, or anytime you would be requiring capital in cash. So maybe you are running a business and there is working capital requirement for day-to-day operational activities. You must invest in short-term funds, money market instruments. Keeping it as cash is not really recommended. You should keep in very limited amount if it is very much needed. But other than that, you can invest in these avenues because these are generally from 1 day to 30 days. It will not end up for a longer time. Then if you want to save on taxes, you could invest in funds like ELSS mutual fund, provident funds, ULIP insurance plans, and national pension schemes. So all these funds would provide you tax deduction under section 80C, which would be about 1.50 lakh tax saving on your investment. Now comes the last part, review and rebalancing. So the investments made for the goals will require to be reviewed periodically. As I said, you just don't need to allocate the funds. You just don't need to invest in various asset classes. You need to periodically review it also to see whether your stocks, whether your investment is performing well or not. So a periodic review will help you identify problem areas and enable early corrective action. For example, if an investment has not generated returns as expected, the goal may not be reached. So, if your investment is not generating that kind of return which you expected, maybe your financial goal which you kept in mind that won't be achieved. So, it's very important that you keep on reviewing, and if there is any chances of rebalancing it, you rebalance it. So, you drop out some of the stocks and you invest in another stocks which you think would be a better potential. So you end up for a scheme and you choose another scheme. So this is how you could rebalance the portfolio. Now rebalancing the portfolio involves modifying the exposure to different asset classes in an investor's portfolio. So you would be rebalancing your portfolio. You would be ending up with some assets and you would be adding some another assets so that you keep on managing the returns you expected. Now let's move to chapter end question. Starting with question 1, which of the following is a financial goal? Option A, rupees 6 lakh required for sister's wedding. Option B, a sizable sum needed to buy a new car in 2 years' time. Option C, rupees 10 lakhs needed for purchasing a flat. Option D, rupees 5 lakhs needed after 2 years to pay child's tuition fees. Now you have to choose the correct option. Take your time and guess the right one. Okay, so the right option is option D. Rupees 5 lakhs needed after 2 years to pay child's tuition fee. Now let me tell you why all the other options are not correct. So whenever you get a question like this, that what is exactly a financial goal or which of the following is a financial goal, you need to focus on three dimensions. First, there should be an amount. Second, there should be a timeline. And third, there should be an objective. Okay, so these all three dimensions, if they are combined together, it would form a financial goal. Now if we look at option A, 6 lakh is required for sister's wedding. So we know the amount, we know why do we need that particular amount to be accumulated, but there is timeline missing. We don't know after how many years we are targeting this particular amount to be achieved. So the timeline is missing in option A. In option B, it is mentioned that sizable sum. It is not defining the exact amount. We need to know if we are defining a financial goal, we need to know exact amount. We need to know after what timeline, after how many years we need that particular amount and for what purpose. So here the amount is not mentioned, and that's why this option is not correct, even when the objective is mentioned and the timeline is mentioned. In option C, the amount has been mentioned, rupees 10 lakh needed for purchasing a flat. But again, if you focus, there is timeline missing. Rupees 10 lakh is required for purchasing a flat, but after how many years? There should be a timeline. So the correct option is option D, because here the amount is present. Rupees 5 lakh, it is needed after 2 years. So the timeline is present, and for what purpose? To pay child's tuition fee. So we are having the objective as well. So whenever you are looking for a financial goal, look for all the three dimensions present in the sentence. Coming to question second, Mr. Khanna requires rupees 10 lakhs in 6 months' time to pay his son's admission fees. An appropriate investment to set aside money for his goal would be option A, equity shares of high growth companies. Option B, real estate. Option C, short term debt fund. and option D is long-term corporate bond. Take your time and guess the right answer. So the correct option is option C, short-term debt fund. Now, let us see why the other options are not correct. So here it is mentioned that Mr. Khanna requires rupees 10 lakh in 6 months. You have to focus on the time period mentioned over here. It is only 6 months. So the first thing that should click on in your mind should be that it is something related to short-term investment. Okay, so the appropriate investment for Mr. Khanna to achieve this particular goal would be to invest in a short term instrument. Okay, now let's see equity shares. We know that equity shares, it is always mentioned, it is always recommended that whenever you invest in shares of high growth companies, you should at least hold for 3 years. Okay, so that's a timeline that's considered as a long term investment, and here what Mr. Khanna wants is 10 lakh only in a period of 6 months. So equity shares is absolutely the wrong option over here. Again, if we consider real estate, so we know that real estate purchase of land and building, it requires a lot of amount of money, and it's not a short term investment. It won't be so liquid as required in this particular sentence as mentioned. So it won't be so liquid to sell and get the money back instantly in a shorter period of time. So the next option, that is the correct one, is short term debt fund. Now short term debt fund, we know that it's less for 1 year time, and here it can be used for achieving the purpose, that is the 10 lakh rupees in 6 months period. So again, it would be having that liquid investment. It would be a liquid investment, and it would be a shorter period of time. So this one would be the correct option. Option D, long-term corporate bond. Again, it would be suggested for a longer period of time. It would go beyond 1 year. However, the question mentions in 6 months. So it is a very easy one where you can easily select that because the timeline is a shorter period of time. One that should be a liquid fund for a shorter term period, and here short-term debt fund is again the correct option. Coming to question 3, Jaya needs rupees 5 lakhs urgently for an emergency medical procedure. Which investment is she most likely to tap? Option A, bank deposit. Option B, shares of XYZ Limited. Option C, gold jewelry. Option D, 5 years bond of a finance company. Choose the correct option. And the right answer would be option A, bank deposit. Now let me explain you why other options won't be correct over here. The first thing that you need to focus in the sentence is the urgency of situation. There is requirement of an emergency fund for medical procedure to be conducted. Now, if we talk about shares, gold jewelry, or bonds, all these are tend to be fluctuating. First thing is that these all three instruments, there would be fluctuation in the prices of gold, there would be fluctuation in prices of shares as well as bond. And when we talk about shares and 5 years bond, it has been mentioned that it's a long term bond. So these two, at least it is recommended that it should be hold for a longer period of time, and it's not recommended that the benefit can be reaped in a shorter period of time. So it need to be hold for a longer period of time. Second thing to be considered. And what you can observe is that shares or gold or 5 years bond, as I mentioned, all the prices tend to fluctuate. So maybe at the time when there is an urgent requirement for emergency fund, it can't be used because maybe at that time the value is not going through the profit, the value is going in losses. And it is recommended that at that point of time you need to hold on to these instruments, because anyone would not like to reap out something that they have something less than what they have actually invested. So there are certain aspects which can be considered. The first thing that we talked about is the fluctuation of prices. Maybe it is going in losses. Second thing which we need to consider, that mostly it is recommended to be hold on for a longer period of time. And third thing is that we can't get the funds so urgently as we require and as we can get in the case of bank deposit. So if we talk about shares or gold jewelry or 5 years bond, we need when we are selling these, when we are redeeming the value, it would be taking time. It would take at least 3 to 4 days time to get back the benefits, or somewhere around a week to get the benefits back into our bank account. So it would be taking time, and when there is urgency for an emergency situation, the best option would be to redeem money from the bank deposit, because anyways you are getting higher value than what you invested, so there is no risk involved of fluctuation in prices, and also you can get the fund urgently. Let's move to question 4. A conservative investor wants to accumulate rupees 20 lakh in 3 years time. What would be an appropriate investment option for him? Again, I'm suggesting you that whenever you are going through these questions in the exam, try to look out for the words that are being focused in the sentence, because then only you can get an idea that what could be the right option or the right answer to go with. Now here you have to see that it is mentioning conservative investor. Now we know that conservative investor are those investor who does not like to take much risk in their investment. So they try to avoid risk, or they try to take lesser risk in their investment. Those are referred as conservative investors. Now such an investor wants to accumulate 20 lakhs, which is again a huge amount of money, in 3 years time only. So what would be an appropriate investment option for him? Now the options given are: option A, shares of selected growth companies; option B, bank deposits and good quality bonds; option C, property; and option D, gold funds. Now choose the correct option. So the right answer is option B, bank deposits and good quality bonds. Now, first of all, the option A is totally incorrect, because it is mentioning shares of selected growth companies, and we know that conservative investor, they generally don't like to invest a lot of amount in shares or equity instruments, because there is a lot of risk involved, and that too for a time period less than 3 years. For more than 3 years, it is recommended to invest in equity instruments, so that the value could be higher than your investment amount over a period of time. But here, since the investor is conservative and would not like to invest in shares because there is a lot of risk involved, looking at the time frame as well. Coming to property, again the investor won't like to invest in property, because focus is on the time period, and again the accumulation which he wants is 20 lakhs, and it is not mentioning how much amount the investor is willing to invest. Now for property investment, the amount required, if we talk about physical property like land and building, the amount which would be required to invest would be a huge amount. So there should be such a capital if you want to invest, and also that's a little bit of illiquid asset. Okay, so considering that factor, then coming to gold funds, conservative investor would obviously want to invest in gold funds, because it is a better option as compared to equity and bonds. But again, to accumulate 20 lakh, it won't be suggestible, because gold funds generally, the interest rate or the benefit that they provide, it's slightly lower, and with that kind of return percent, this accumulation of 20 lakh rupees won't be possible. So what would be the best suitable option in all these? So it would be bank deposits and good quality bonds, which again would provide, bank deposits again would provide a secure investment, because he's a conservative investor, do not want to take much risk. Even the gold funds would be even the gold funds would have the exposure to fluctuation in the prices of gold, but bank deposits would be totally safer instruments. So looking at conservative investor approach, bank deposit again would be the appropriate investment option for him. Along with that, some good quality bonds which can be trusted and can help in accumulating this amount of money. Looking at the time frame, so the best suitable option would be option B, bank deposits and good quality bonds. Thank you for watching. I hope you liked the video. Thanks for all your support.